Hey everyone, welcome back to the channel. Today we're going to take a look at Facebook, do a little DCF on them. So first thing just to note, right, they're trading at $298 a share, market cap of $850 billion. I think this makes them probably like one of the 5 or 10 largest companies in the world. Um, I think like Amazon, Google, Apple, Microsoft are above them. So they're probably fifth largest company. They're my I don't know what Berkshire's at. I think they're like 600 to 700 billion, but so pretty large company. Um, I've went ahead and thrown together DCF. So the big thing here is they provide income statements, right? So I pulled all this. We can see, right, net income has grown drastically in just the last 6 years here. Um, on top of that, revenue as well. So a lot of growth while keeping costs kind of in line and staying as a profitable company. Pulled their capex and their DNA. We can see capex is growing rapidly, which I think is a good thing. Kind of maintain the growth for them. Stock comp is a big piece, and tech, stock-based compensation is a big factor of compensation, right? So I mean, they're paying what, almost 10% of their revenue out as stock-based compensation to their employees. Um, then just a few kind of interesting things that we'll need. And actually, let me add a couple rows here. But they provide daily active users for Facebook, monthly active users for Facebook, and then the average revenue per user per quarter. And they provide this, and this is Facebook as well, by country. And then they provide a high level for all of their products, the daily active users, the monthly active users, and then the average revenue per quarter. And so the average revenue that I pulled in here, this is the revenue as of December 31 for that quarter. And their revenue is seasonal, it looks like, or I guess their average revenue per customer. So it fluctuates throughout the year. So it kind of goes up and down. But I just pulled in the December 31st just so that we can see at the same snapshot in time how it's growing over time for each region. So the thing we're really gonna have to figure out here is we're gonna have to project out active users. From there, right, we can get daily active. From there, you can look at, how it's a proportion of the monthly active. You could scale up your monthly from there. You can calculate what you think, how revenue is going to continue to increase or decrease per user. And then we can get a total kind of revenue number. And then we can also, or you could also look at it a separate way, right? You could look at it as all products in here and just kind of at the high level average. So a couple ways we could do this, but I think I'm going to start off from this aspect because we can see the country level. And I've actually pulled in just like some high level population statistics because clearly their users can't ever go above these, right? So the US and Canada, this is US plus Canada, sorry. Right, 366 million, Europe 746, Asia Pacific 4.3 billion, rest of the world 2.3 billion. So in theory, right, monthly active users can never go above, what is it, 7.7 billion people. So I mean, they have about a third of the world on their platform already. So right, if you were to just triple it overnight, that would go up to 210 billion a year in revenue. Um, Obviously, they'll never get the full population. That's just not actually possible. But anyways, let's jump into this. So kind of looking at this, right? 10, 4, 2, 4, 5. So it looks like they've been averaging about 4 or 5 million more users a year in the US and Canada. So let's just set this to 4 for now. We'll kind of see where this kind of gets us to by 2030, right? 235 million out of a population of 366. That's probably reasonable. If we look at Europe, right, 20 million there, 15 million, 15 million, 12 million, 14 million. So I'm going to do 15 million people a year. That seems reasonable for Europe. We'll kind of see where that gets us. And obviously these growths would probably slow over time, but population grows as well. More people become of age that can actually use the platform legally, because I think you have to be like 13 or something. But anyways, and then let's go ahead and look at Asia Pacific. This is a big growth driver right there, right? 100 million, 100 million, 80 million for all intents and purposes, 70 million, 100 million. So let's do 80 million for now. This is a large base, right? It's what, 4.3 billion people. So not crazy to think that they could actually end up with over a billion people just from Asia Pacific on their platform. And then rest of world, right? So 60, 60, this one grew 30, back up to 50, 60. So let's just go 50, kind of in the middle between the 30s and the 60s that we're seeing there. And then we'll go ahead and calculate the total amount. So we're saying, 10 years time, 3.3 billion, population of 7.6 by then, right? Population continues to grow. You're probably 8 point something billion. I don't know how fast population grows, to be honest, but right, population continues to grow. Maybe not all that crazy to have, a third of the world on your platform, a little over a third of the world. Seems reasonable. And then obviously the monthly active users, and this is daily users. Monthly active users is more. And for this, I'm actually just gonna let's add in a little section here. How many rows is that? 6 rows. Is that 6? Okay, 6 rows. We're gonna do it as a percentage just to kind of feel like it might be kind of hard to actually try to guess out, monthly versus daily users. So we'll just do this as a percentage, kind of see what it is. Um, I guess we could center align all of this. Oh, formatting. Okay, whatever. It's fine. It's going to look a little wonky. We'll get over it. So what we'll do, if I'm thinking of this right, you take this number and we'll divide it by whatever percent we put there. And then that will, so right, if we set this to 76%, yep, gets us the number we're looking for, 263. And I mean 77, 78, 77, 76. So for now, we'll just kind of leave that steady. Let me make these blue, so if you guys go ahead and download the model and you want to tweak anything, where we put our own assumptions in, where you can change things. So this is about 74, 75%. I'll just leave that. It's actually going up, interestingly enough. And same with this. But for now, just kind of this first base case, let's just leave these assumptions flat. And then we can actually just set this as the same formula and see if we get relatively similar numbers, which we do, right? 66%. Stays about the same, we have it slowly declining. Seems fine to me, seems reasonable. Here's the part that's hard. Average revenue per user per quarter. That's a hard one to estimate, I think, honestly. Right, we've seen this go jump $2 here and then jump $10 and jump $10 and then jump $7 and jump $12. So I mean that's a hard one to really guess. Oops. I'm just going to add $2 for now. I think that's a pretty conservative estimate, and we'll see kind of what valuation we get after we do this. This one, right, it's going up about $2 a year as well. So I mean, we could actually probably have this one be higher than 2. I mean, what's the? I guess I can just not be lazy, and we can calculate the difference here, and let's take the average of this, and we'll use that. So average is 8. That seems high. I don't like that. Do 5. I mean, I don't know the advertising business that well. This would be something to really use some research on. Can you actually generate $100 of revenue for someone using your platform? I doubt it. I don't know, but maybe. in here, right, we've gone from $1.60 to $4. It's going up like 50 cents a year. So we'll just leave it at that. And like the Europe one I'm comfortable with, right? Like it still doesn't even hit where the US is. This is nowhere close. But the US, I don't know if you can actually get that kind of number. But we'll see 30 cents, 40 cents, 30 cents, 30 cents. This is going to about 30 cents a year, so we'll just go ahead and do that. Average per user, I mean, you could calculate this as a weighted average. That's a lot of work, right? You would do like this times this times this, etc., and then divide it by the total user base. But for now, I think we're good to skip over that. Now we're going to calculate revenue. This will be our kind of first pass at revenue figures. And I'll show you here in a second. We're going to have to make a few adjustments. I'll show you how we do that here. So the numbers they give is, this is per quarter. So you take this number times 4 times the monthly active users. Now you'll see when we do this across, and then we sum this up, we get 23.6 billion. You'll see their revenue was 18 billion. So the difference here is, like I was saying, there's seasonality in their revenue per customer. So I think in like Christmas time, right, you're going to pay more for ad clicks because you're trying to sell and compete. So it fluctuates. So what we're going to do is, this is like the raw calculation of revenue per customer. And then we're going to come in here and we'll pull in actually the actual revenue per customer. I actually don't think we have it at the country level, no. But then, so we can pull that in. What this is going to allow us to do now is just kind of make a high level adjustment for seasonality. You could go in their statements and you could pull, I think they provide quarterly data, so you can make this calculation a little bit better. But what I'm going to do is just, and I want this to just be a percentage. That's fine, that'll all correct itself. So 76%, right? And we add in like one more row now, and now we can actually calculate the, this would just be like revenue per, this would just be revenue pre-seasonality. Oh, actually, no, this is actual revenue. Actually, I don't need those ones. I don't need that. But then here, now we have, this is revenue pre-seasonality. And from here, right, so we can copy this formula over. We get these, and we can see, like, so 76, 77, 77, 70, 82, 83, 76. So we'll probably use about 77% here, is what I'm going to go with for this one. Make these blue. And you'll see how we back into everything here in a second. These are NAs, we don't need to worry about that. I'll just gray that out. And then here, now we can continue our calculation. This is a sum, that's multiplication, but that should equal more or less. Copy those over. Oh, bummer. I didn't want to mess with all the formatting. We'll sum this stuff up. And we'll see, like, I mean, this is a aggressive growth, right? We're assuming Facebook just continues to grow, right? They're still adding 20 billion a year onto their revenue, basically, pre-adjusted. But after we adjust it, right, now we'll call this revenue adjusted for seasonality. So what we're going to do is we'll take the revenue number that we just calculated and we'll times it by this. Help if I hit the multiplication. There we go. Oop. Okay. And this should give us, and we can check here, fat finger and all sorts of keys here. But then, right, this is going to be pretty close to tying back out. So yeah, I mean, those are pretty close to being tied out. And then we'll copy these over. And this is really our first, oops, this is really our first estimate at revenue. So, and we can, we can ignore the total product piece for now. Right, we could do something similar, but it's at a higher level, less of a country level. And Facebook drives, I'm pretty sure, a majority of the revenue that they make currently. But so here we go. Here's our, our first revenue estimate. So I'll bold that. I'll make that yellow because we're gonna have to link that up onto our model. Revenue, total revenue. Sorry, I'm just trying to make some of these tie outs that make sense if you download the model. Since I added a bunch of rows here, average revenue. Okay, so there we go. Come back to our DCF now, and we will, for this one, we're actually just gonna link it back in from here. And then we'll calculate the growth rate. So let me make this green so you guys know that it's a link. It's the wrong color green. There we go. COGS, so that's formula driven, but just do this real quick. So I haven't adjusted any assumptions here. This is just probably from the last model I had. So we can go ahead and make some adjustments here, but so actually this is 17, 18, 19. Let's just set it to 19 for now and have it stay constant. SG&A, 21%, that seems fine. I actually think I need to link up this other again. Let me see. Yep, other. So we'll start here in 2018. Copy that over. I believe that's mostly R&D. There we go. Now we can kind of adjust all this. 21. Let's make sure these are formulas are linked up. Yep, okay. So those all look good. Tax rate looks fine. So for now, 21, 21, and then 21 for the tax rate. That's all good. All dandy, perfect. CapEx, let me make sure that this is linked correctly. So we want to start with 2018. Yep, that looks right. DNA, just make sure that that's linked up correct. It is, okay. So yeah, they're really investing for growth, right? Their DNA is 45% of their CapEx, which is, and it's increasing, right? Increase 7% a year there. That's impressive. And CapEx being 18% of revenue is pretty crazy. You usually don't see those kind of numbers. So I'm going to do this and decrease. It looks like it's been decreasing 3% a year. We'll decrease it 3% a year until we get to like a 6%, and then we'll leave it there because I think that's kind of like a steady state, slow growth. It's kind of how I look at those things. And then this has been increasing 7% a year. We'll do that until we get to about 80%. If we even hit that, yep. And then we'll leave it at 80% from there. So there we go. And then working capital, we got to link this up real quick. So balance sheet, let's look at our current assets. So AR we'll take, and then prepaids we'll take, and then current liabilities. Let's see what we got here. We got AP, partners payable, accrued expenses. Do those. Basically just wash out. It would help if I link this to the right year. So this should be C. This is the same. These should be C's. There we go. Now we're talking. And that's kind of all over the place. So let me add three lines in right there. And we'll do current assets as a percent rev, and then current liabilities. So sometimes if the net working capital ratio is just a little funky, it's easier to just calculate it this way, and you can hopefully get something a little bit more consistent. And sometimes it looks weird, right, if a company is actually experiencing like high growth. Um, things can look weird because these things don't always necessarily scale. Um, so there we go. So we'll copy this over. We'll make that a formula now. This will be a formula as well. Make this black. Okay, cool. So now we can forecast this stuff out, which will be good. So let's do that. Sorry about this. Just trying to make everything look nice for you guys. So if you download the model, okay, there we go. So, I mean, this one has averaged 16% and this has averaged 16%. Okay. I mean, this isn't going to be very exciting for net working capital, but that's fine. Link those in. Do the same here. Oh, gotta. And then now we'll just calculate this, right? So this will be this times revenue. Lock it there. Oh, wow. Yeah. I mean, um, interesting. That's fine. Kind of weird, but make this way, you know, I mean, it won't be exactly the same. Um, that's fine. Nothing crazy. It basically just neutralizes the impact of working capital, which is fine for a DCF, kind of what I prefer actually. So let's go ahead and look NPV of these, right? There we go. You get 269 billion, 8% discount. I mean, I don't know how I would throw a 10%er on here personally. Facebook, I think, just has a lot of regulatory risk. So who knows? Terminal value, present value of that, enterprise value. And then let's calculate the net debt. So this is going to be debt, which they have none of. So we'll do equals 0 minus, and then we want to subtract cash and marketable securities. So this should actually be, that should come in as a, there we go, get added back. So, you know, in this first pass, right, you get, and you know, if we put this to 10, put this to 9.5, put this to 10.5, right, you get a valuation range of 650 to 785, right? If we go back, market cap's 850. So, you know, it could just be people think this isn't as risky as I do. So you could throw an 8 on there, 8.5 there. You know, if you think that that's kind of the risk profile. And I think what this is really telling me is, you know, maybe 8% is fine for Facebook. It's a massive company, right? Like maybe it's really not that risky. But you could come back and you can make some adjustments here. Maybe we don't think it's going to grow this quick. Let's do it at a +3. Do something like that. Instead of averaging 15, like they have historically, they're going to average 10. Instead of +80, let's give them +60. Right, like we could come in here and we could probably play with these and actually probably get a pretty reasonable, you know, let's make this 40. Right, so, you know, we just drop this, what is it, 400 million people by 2030. Just doing that, like what's our range at now? You know, we're still on the low end, 820 to 1.1 trillion. So, I mean, you could probably even make this a little bit more conservative. Actually, these are inputs. Let's make these blue, right? Instead of gaining $5 a year, you're going to gain $2 a year in the US. I mean, I think this one will actually pretty drastically impact the valuation here. I mean, I think those are fine. I mean, you're still getting pretty reasonable valuation there. So, I mean, yeah, this is actually, you know, not what I was I guess if you believe Facebook is going to be able to overcome regulatory issues, right? They're not going to get broken up. They're not going to start just, being a platform, having all the issues of you're the largest platform, you're controlling elections, whatever, all that stuff. You know what I mean? They can overcome all of that, continue growing, basically not even double their user base um, in the next 10 years. Yeah, they're probably fairly valued today. I don't know if that's what I was expecting, to be honest, just because it seems like everything in this current market's overvalued. But this might be one of those plays where if you actually believe in it, and if you know more about advertising revenue and how that is scaled, right? Like you could make accurate predictions here and understand like they're going to be able to turn Europe into the same thing as the US, and you'll be at $53 here, and US can just stay at 53 in that case probably, and you're going to come out ahead just because it's double the user base, right? So if like, you know what I mean? There's a lot of levers, or if you're like, oh, they're going to be able to rapidly scale this 405, right? Like, I guess what I'm saying is if we leave these flat, even for um, Europe, and we're like, no, they're going to be able to grow this $2 a year for Asia Pacific. Like, they're going to be able to ton of money, right? Just doing that. Um, you know what I mean? So I think there's a lot of ways to get their current valuation that could all be reasonable, right? Can you heavily monetize the Asia Pacific market? I don't know, rest of world. And a lot of this, right, there's a lot of the population here that's definitely lower income individuals that are using the platform. Um, so it might be hard to monetize at the same rate in the US where your average user is definitely wealthier. It's the same with Europe than your average user in Asia Pacific or rest of world. So uh, definitely an interesting thing. But I think they're probably like relatively fairly valued. I don't know. I'd love to hear your thoughts if you think I made any crazy assumptions, anything you would change. But like I said, the models, I always link it to it in the bottom of the video if you want to download it and just mess around with your own inputs. The blue cells are the ones that you should really be changing. Everything else is kind of linked up. So yeah, thanks for tuning in, and leave your questions, comments below. Appreciate it.